Chapter 5, Operating and Financial Leverage. The next thing would be nonlinear break-even analysis. The assumption of exact linear relation does not hold good in reality. As you can see on here, you'd have your break-even point, your total revenue and total cost, and how it kind of bows out. The further up you get, you can see that it becomes non-productive. Financial leverage reflects the amount of debt used in the capital structure of the firm. Determines how the operation is to be financed. Determines the performance between two firms having equal operating capabilities. The balance sheet, assets and operating leverage versus liabilities and net worth is your financial leverage. Impact on earnings. Examine two financial plans for a firm where $200,000 is required to carry the assets. Total assets is equal to $200,000. Plan A, leverage, debt 8% interest, $150,000, $12,000 interest. See common stock at $50,000, 8,000 shares at $625. Plan B is $50,000 at $4,000 interest, $150,000 at 24,000 shares at $625. Total financing is $200,000 between the both of them. You also see the impact of financing plan on earnings per share. Earnings per share is still 25 cents between a leveraged and conservative plan. But your total earnings per share at the bottom after EBIT, once you get higher up, it becomes vastly different. At 60,000, your earnings per share on plan A becomes $3 versus $1.17 on a conservative plan. But on the opposite end of the spectrum, EBIT at a lower amount, you're negative 75 cents on plan A, but you only have lost 8 cents per share on plan B. Financing plans and earnings per share, as you can see here, your break-even analysis. And then it breaks off from there. Plan A, greater return but greater risk, and plan B, less of a return but less risk associated with it. Degree of financial leverage. Percent of change in EPS over percent of change in earnings before interest and taxes. For the purpose of computation, it can be restated as degree of financial leverage EBIT over EBIT minus 1. Degree of financial leverage for two plans to be calculated using values from table 5.5. Shown here, plan A ends up being 1.5 and plan B ends up being 1.1. Limitations of use of financial leverage. Beyond a point, debt financing is detrimental to the firm. Lenders will perceive a greater financial risk, and common stockholders may drive down the price. Recommended for firms that are in an industry that is generally stable, in a positive stage of growth, or operating in favorable economic conditions. Combining operating and financial leverage. Combined leverage when both leverages allow a firm to maximize returns. Operating leverage affects the asset structure of the firm, determines the return from operations. Financial leverage affects the debt-equity mix, determines how benefits received will be allocated. Combined leverage influence on the income statement. Sales, total revenue $160,000, showing your operating leverage. Operating income is $36,000. Earnings before taxes is $24,000, taxes $12,000. Your financial leverage is in the earning of taxes. Shares, and your earnings per share at the end at $1.50. So your separation from EBIT all the way to earnings per share is your financial leverage. Your operating leverage is all in your sales, fixed costs, and variable costs. The last item under operating leverage, operating income, becomes the initial item for determining financial leverage. Operating income and earnings before interest and taxes are one and the same, representing the return to the owners before interest and taxes are paid. Combining operating and financial leverage, as you can see, both added on here and the leverage impact that it has. In this table, you can see the difference when you combine the two and operate them to get your maximization of your earnings per share. 80,000 units, it's $1.50. 100,000 units, it is $3. Degree of combined leverage. Use the entire income statement. Shows the impact of a change in sales or volume on bottom line earnings per share. Degree of combined leverage is the percent of change in EPS over percent of change in sales or volume. Using data from table 5-7, you can see the difference of percent of change in EPS and percent of change in sales, which will give you a total of 4 with your combined degree of combined leverage. Degree of combined leverage, as you can see the formula at the top, your quantity times your price minus your variable costs per unit over your quantity times price minus variable costs minus fixed costs minus your interest, which gives you a degree of combined leverage of 4. That ends chapter 5. Anyone has any questions, just feel free to send me an email and let me know.